Welcome to the Market Mindset. We are the hub for news, results, and CEO interviews focusing the junior commodities sector. We provide market analysis and perspective that will help position you for solid returns. If that sounds like something you're interested in, you can help support us by liking this video, subscribing to our channel, and clicking the notification bell. For more info, you can visit our website. All links are in the description below. Now let's get into today's video.
Happy Friday. Welcome, Austin. It's a beautiful sunny day here. It's a wonderful day. And you're going to walk us through, and I'll have some comments, investing versus trading. And this is critical, especially during a chaotic time, and as well as kind of what we do. It explains the market mindset and our approach. So how are you doing? And take it away.
Doing good. Yeah, doing great. And we want to just kind of outline what the kind of core differences are kind of established between the two, what investing is, what trading is, and then take a look at why we prefer usually the investing model, and then we can poke some fun at me and my experiences with trading. I figured that would be the approach. So we'll jump into it just really, you kind of expect most people to understand the general gist of the differences, but we'll break them down really quick. Investing is more of a long-term growth mindset approach, tends to be less risky, although that, depends on when you're getting into more highly speculative stuff, which we like to do a lot of the time. But it benefits from kind of the stability in the market, consistent growth, more of a fundamental analysis of the company itself. It involves, like buying and holding on to a stock. And then it's kind of the best approach for growing capital that you already have. Trading is much more short-term, much more profit mindset, definitely on your normal investment that you're trading versus an actual investing is going to be much more risky. It benefits from volatility in the market rather than stability. You get a more technical analysis of, people looking at what you call candlestick charts and stuff like that. What's the short float looking like? How can we, maximize the opportunity to buy and sell at different points here? And you're kind of riding off market waves throughout it. So that's the general kind of overview. Do you think I've kind of got it on the right track there, Andrew?
Oh, you bet. Yeah. That time factor, that's a big component when people think they go, there's a couple of different stages for trading, anything from I've got a position, which could go for a year. You could hold a futures contract or an options contract for a full year. But generally, when people are saying trading, it is maybe a week. There's swing trading. It could be day trading. So just for the day, they're in and out. Or it could be literally, you could be on a trading floor. You could be on a trading desk. You could be at a major investment bank on the desk, and you're trading like seconds. And that's usually when you see the people in a giant room, it's hustle and bustle, it's loud, and they've got like 5 monitors and talk about stress. It's just buy and sell very fast.
Yeah, and you're looking at trying to ride those the market waves that are there to maximize your profitability. And it's extremely exciting, but I can speak to it from personal experience. It's extremely stressful and extremely draining.
Yes.
To be focused in on something and try to be locked in all the time and knowing when you're going to make the right move and if you're even making the right move, because you can easily sell something and then see the stock continue to just go up and that can end up burning you in the long run, or you could end up buying more you think you're buying it at a dip, and that dip could continue falling through the floor. So it creates a lot of stress. I much prefer the investing method for my own peace of mind. But it's different for each person and what you enjoy doing, what you find your personal strategy works for the best, and what you find the most exciting as well.
Yes, I know that there'd been a long-term report done. I think JP Morgan had one, and it was stating that over the long term, you're going to make more investing than you are trading. And that's just, I would think, that's common sense. I think most people would agree because most people can't spend enough time. Right now we're kind of in a unique situation in history where people have had kind of 2 years of lockdowns where they're at home. They can go look. They can start doing this kind of stuff. Before, it would be you've got a job and something else, and you're just saving, and you have someone who's helping you kind of make a whole plan. But generally speaking, the investing approach, which has all sorts of different terms as well as to the length of time you're holding, if you're doing more of a portfolio, and of course there's nuances between both of those as well, because you can have like the investing growth type of thing, what we do, which I consider ourselves fundamentally driven from a macro or a top-down approach. But we like to get in right when it would be like a venture cap stage. Like we like to get in before the IPO if we can, which is a whole different strategy, an entirely different mindset than if you are a commodities broker on a desk at an investment bank, or you're trading currency futures, where you're trading massively leveraged amounts of money, hundreds of millions, to make small gains and just in and out. And they don't really pay any commission as well. And most of the time, even for retail, you don't pay a lot of commission anymore, but you're paying. But I mean, you go to Wealthsimple, you think, oh, I'm not paying commission. You are paying. You're just paying in the bid-ask spread. But that's a whole other nuance too, as to if you're trading, your cost of trading is one of the key things. Most people will blow out any gains they have by going in and out so often and so fast and just paying their broker or their online broker, whoever it is, in fees, even if it's only $9 a trade.
Yeah, because you highlighted it perfectly there. Because even if it's one of these free without fee ones, you're getting it on a delay where they're still able to maximize their ability to take a little bit off the table as they do that as well, which is interesting. And we could have, that's a whole nother kind of conversation that we could have. But there's always going to be tricks and nuances to whatever kind of platform you're going to be using, and regardless of what you're doing. But for the trading side of things, working off of a platform like that, where you're either being charged upfront or behind the scenes for each transaction, then it starts to absolutely become a bit of a money sink when you're trading so frequently.
Yes. And it depends on the types of markets too. Like, I mean, trading will generally, and once again, this is very general, is someone who wants to take advantage of the up and the down of the market. So they would argue with me and say, Andrew, you don't short any stocks. In a down market, I can make money all day long. And they're right. They can. They can be shorting all sorts of stocks that I like because they may not have news. They may not have news for 2 months, and they will short it and they'll make some money. That's fine. That's a strategy that works. It doesn't bother me because those short-term moves don't do anything to me. But for someone who's a trader, I understand, because that's their mindset. They can't leave it alone. Like they can't look and go, I can see this management team. I trust them. I can see where this can be in 2-3 years. To them, 2 to 3 years, you might as well just say like they're dead. Like life is over. That's too long. So they definitely live in the now, and there isn't any right or wrong, because if you're a good trader, you'll never. You might take some of your money and invest it into real estate and other things to diversify, but you're good at it. You make a lot of money doing it, and like you said, you're going to get jacked off the adrenaline of those up and downs all day long. And if you do, regular life's going to be very hard for you. It's going to be tough to get away from it because it's exciting. It really is.
It absolutely is. And there's a time and place for it. Like I mentioned, I would use the example of GameStop, which if a lot of people remember from about a year ago, went on a massive tear from about $38 a share all the way up to 350 almost over the course of a few days. But that was an opportunity to actually trade, because if you were buying that stock with the intention of, I'm going to hold this, you could look at where you'd be sitting now wouldn't necessarily be the best. I mean, hey, if you got it at $40 a share and it's at 125 right now, you're still feeling pretty good about it. Like, make no mistake about that. But if you were looking at your portfolio and it was up over $300 and now you've got it sitting at 125, you're not feeling too great about it.
No. And that's where we kind of say, you better stick to your model. Because if you change your mind midway through and you forget why you got into this, maybe I better start you'll throw yourself off. You have to commit and know what you're doing for each position that you're getting into. That's one of the things we stress. And the other thing with investing, and we've talked about it before too, is the notion of passive versus active investing. And once again, very generally, if you're a passive investor, you're buying funds. So you're buying ETF, maybe you're buying mutual funds, and you're just kind of squirreling away money. It's in a AGF, Canadian equity, whatever. And you're looking to get market returns, and that's smart. That's good. Because once again, you're maybe not even interested in investing. You may not have the faintest idea or any interest, which to me sounds baffling, but I get it. You know, I don't have a lot of interest in engineering and how to put up a building. I mean, I just don't, or surgery. It doesn't interest me. So I get what people aren't interested in it. And that's great. They should just save. And then they work with a planner, a consultant, a broker, and they get a good portfolio together that'll get them hopefully better than market rates of return. And they can, you know, meet all of those dreams and visions for the future that they want. And that's critical for most people. When we're talking about active, which is what I've kind of been advocating for the last couple of years, is saying, listen, we've gone way too overboard with this passive stuff. I mean, it's way too much. And it's great. We've got a lot of people excited about investing enough to focus on saving and giving it to someone else to invest for you. But that there is an opportunity, if you showed a bit of interest and curiosity in the market, you could start picking out. So you're getting a bit more interested, and you go, okay, you know, I think that this energy thing is looking good, or I think that, yeah, maybe we are going to be using copper in the future. Then you start going, okay, what are some of the companies that I could look at that I could take advantage in? So then you're becoming a bit more active in it. And that active, I mean, it's probably not day trading, but it's certainly, you're now picking stocks. And that was originally what people thought when you were a stock broker. They don't really call them stock brokers anymore. They were pitching you stock ideas, and they had some ideas and they made you money, or they didn't. And that's how they kind of made a living. Nowadays, if you're at a brokerage, you're probably not stock picking. You might be at one or two that have private placements, but it's highly unlikely. It's chances are you've got a portfolio and they're addressing your entire portfolio. It's a very different type of thing. And they may or may not even be allowed to pitch you a stock. So that kind of world has shifted to the likes of myself and many others, where there's safety in that, because you're saying we're all in this together. We're too big to fail. And if we all fail together. So no one feels bad. Whereas I'm saying, yeah, sure, that's okay. But there are screaming values out there if you pay attention, which is our model.
Yeah, it absolutely is. And it's important to define that difference between active investing, which is, you know, looking at the companies, but still, you know, with that growth mindset, long-term idea behind it, and then trading, which is still very different. Yes, you're picking stocks, you're trying to time things right, but you're doing it in such a condensed time frame. I mean, like, for example, when I was day trading GameStop, I was quite literally day trading within, you know, half an hour sometimes, saying, oh my God, it's falling through the floor. Let's get a bit out here. Let's wait. It's going to bounce back. And you can see the way it was made. It's exciting. It is totally an adrenaline rush that you can get caught up in. But for me personally, a week and a half of doing that was enough of a learning experience, and I don't need to worry about doing that again.
No, I even remember when I graduated university, visiting friends in Toronto that worked at on the floor of HSBC. And I think the restaurant / bar was called Canoe. And any of our Toronto friends will write in and tell me it was on the top floor. I think it was the 40th floor or something. And it was right beside the trading floor of HSBC. And just visiting some of them, and they just looked haggard after 7 months. Like they're like on the job for 7 months. And you can see why a lot of them, if you're actually at a big investment bank or trading floor, you might only get 4 or 5 years out of you before you burn out, because it's just the stress, the lifestyle. It's very tough. But it's not like they don't. I mean, some of them don't ever have to work again, but most of them go on and create their own funds after that. Yeah. And they probably take a little bit of a calmer approach to life. But the tough thing too is it is the time thing. Like, I mean, that is the toughest part to manage, because even for myself, where I would call it midterm, like 2-3 year type of person, you want to look all the time. So you want the news flow. And especially when you see everyone else, like if I see someone in crypto and they're like, oh, and they're talking about it all day long with the most minute information, that, is, to me, sounds like noise. It's exciting.
Yeah.
Whereas my brain's like, oh, I need that for my approach. It's like, no, I don't. I need to just know that it's being taken care of by management that's smart and doing their jobs. I don't need to know how to downhill drill or anything like that. I know that they know how to. It's letting it go and watching to see, has anything changed in the model that they've presented in their thesis? And if it has, or if they're not getting results, then we reevaluate.
Yeah.
It's almost just as hard to have your strategy and let it go than it is to want to pick at it and go, oh, maybe I should do this now, maybe do that, because you feel like you're working. So part of investing is distracting yourself enough to not keep on overthinking it, overanalyzing it, is just looking to see, has the news changed in any way? And the best thing to look at, because it's this morph of the two, is when you look at some mining stocks and you see, okay, this is a very unique situation where the stock runs up on the anticipation of news, or people thinking, oh, they're drilling right now. People are excited. They're interested. They might hear, oh, I think it's going really well for them. It's all just speculation. The stock might run up. And then sometimes you see this. It's quite often. As soon as they come out, boom, great news release. The stock drops.
Yeah.
And everyone goes, what? Well, because there was enough people that were trading in there. And if you're an investor, you go, this makes no sense. And you're driven irate. But it does make complete sense if you're a trader, because they don't, they trade off of the speculation, not the facts, the sentiment. So the momentum, they look and they go, I can clip, 10 or 15% off here, in and out quickly. I'm out. Now they might get burned long enough doing that type of thing. But if you're an investor, you're thinking, no, they've hit phase one. I'm going to go in, and 6 months later, I'm investing again. They've hit phase two. So your long-term results might be way, way higher, but it's just stretched out a lot longer, possibly more painful, because you just don't understand why great results, stock drops. It's so frustrating.
Exactly.
It's not funny. I'm laughing because it happens so often. But and believe me, I get the emails and I have people and I just say, listen, this is what happens. And I mean, there's more to that. And I think we're going to have, like, in our subscribers section as well, frank discussions on how this actually works. When someone does a private placement and they might be in it like 20 cents and you get their first results and it goes well and the stock hits 80. I mean, some of those people are going to want out. They're just going to go sell half the position. Boom. So you can see where the volume and the flow and whatnot all come into play. And in the mining sector, that mixture of watching the stock it's important to keep in mind.
Yeah, it is for sure, because like you said, you may have someone who, let's say it's even just $5,000 that they've put in at 20 cents. If it goes to 80 cents a share, you pull out half your position, you've more than already covered your initial investment. So that's on that person's front, that's good business as well in their approach. So but like you said, it can be so frustrating, and a great example of that is a company like QU, who have had nothing but great news for the last 6 months. Continued revenue increases, new advertisers coming on board. They've had great additions to their management team. They're launching new channels, new shows and stuff. It's like, hey, wait, all this news is great. How come the stock's not moving? And you just got it's a lot of the sitting there waiting, twiddling your thumbs, kind of going, all right, I know the blueprint's in place. It's just, when is the market really going to adopt this? And when is it really going to take off and get the growth that it kind of deserves?
And also, and for sure. And I mean, you have to look at the fundamentals again and see, is there something that's changed in management or strategy or numbers that I should dump it? And it is frustrating when you can't find that. You go, they're like, I know they had one show that kind of flopped, but really that's compared to the revenue they've been generating, it's great. But then and there's always possible reasons for any of these types of things. And certainly with QU, one of them could be just whenever we hit massively chaotic markets with a whole sorts of uncertainty, people tend to flock towards safety, where they think that they should be safe, and they sell their juniors. So, and that does make sense to a degree, because they go, there's not enough volume trading in a lot of these juniors. I need to get out of that first. And then there's more volume of trading in the bigger ones. I can get out of that second. So there is logic to it. But to me, I look at that and I go, it's the exact opposite for me. If this company is doing what they say they're going to do, they're in a sector that has a big fundamental supply and demand issue, and nothing has changed. Like not only that, it looks more robust. Then them getting out because of volume tells me you have overplayed your capital, and you don't have enough to live on, which is not good as well. And you need to revise your strategy to make sure that you can take like these are opportunities. You can get this stock now for a lot cheaper, and build a position. So this is kind of a sneak peek into how we think and how we look. And because it's quite unique, a venture cap fund often might have the mandate of only doing the venture cap part and then exiting as soon as it hits the market. So they would be in doing the private work behind the scenes before it even gets to the market. At a market, they might be dumping it. So there's all sorts of different strategies that kind of get morphed in. We tend to want to get in as early as possible and cheap as possible, because we see what the entire plan is and that they have all of those things. And that's hard to find. They have the management, they've got a strong backing, they've got a good network. And if you look at companies like GMG, DME, these all have that. Even GasX, which is being punished again a little bit here. They're not hitting their milestones as much as we'd like. These are things that you just kind of have to watch and pay attention to. And also, I'll just mention this. I'll do it once in a while, and you go into some of these forums and chit chat rooms. They can be good to sense sentiment, to see what people are out there. But you also have to take a massive, large grain of salt with that, because this is the den of the trader. So this is the penny stock trader world where they hang out, and they will push a stock up, down, sideways, you name it. There are people in there that's literally just their life. They will, half of what's in there could be complete horseshit. Sorry for my French. You have to take it with a grain of salt, because there are people there that are purposely pushing stocks up and purposely pushing stocks down. And that's how they make their livelihood. So that for a new person might seem like that's not fair. That's not right. That can't happen. It's like, well, it does. And you have to have that resolve to know, why do I want a position in this company and where are we going? And unless you're in constant contact, like I can call these companies a lot and chat with them. And I look at it all day long, so I feel comfortable. But if I'm someone who goes, Andrew, I like some of these ones, a month down the road, 2 months down the road, you forget, why do I like DME again? Like you have to just constantly be reminded. And otherwise you just go, you know what, it's down, it's not moving, I'm just going to sell it, move into something else. That's why we always want people to stay engaged with us, reach out, because even if they look and they go, I don't see anything happening with it, I might not know anything either, but just having the conversation might remind people as to, yes, this is why we're in this. Yes. Oh, I totally forgot about that. That's where like the community kind of part, having that engagement with each other as to realizing why do you like that one again? And it's a little easier to send an email or a text or whatever to Andrew or Austin as to why I like something, rather than I'm going to go watch a whole video again.
Although if you do want to watch a whole video again, we've got a new section on the website. We're going to be updating it with kind of these blog posts that are going to look forward looking and kind of backward, rear view looking, different posts. And the latest one that we did there was on DME, and we took a look at a great interview that you and Robert Rolfing did back in October, I believe it was, talking about the fundamentals, talking about what their next milestones were going to be. And it's cool to look at that, look back and say, hey, Robert said we're going to go do XYZ. And well, they went out and did all of those things. And the stock reflected it when you think about it, was hovering around 80 cents at that time. And even now it's close to about $2.60. So great sections in the subscriber area. If you're not signed up to the website, get in there, get signed up, go take a look at the blog posts. We're going to be updating them frequently with all these different ideas and looks back and forth, and trying to keep you connected into these stocks and why we love the model that we have and why it works the way it does for us.
Yeah. And that's it is to try to honestly try to grow out that engagement with the people that do like what we're up to, what we're doing, and do like the companies that we work with, that we've picked. We're looking at some really cool ones. Like we've got, I'll let one little cat out of the bag, and it's like, am I actually looking at a salt company right now? Like, am I actually looking at a salt company? Let's just say that. Am I?
When you told me about that the other day, I said, at salt? Okay. All right.
What? Am I actually doing that? So yeah, maybe I am. But you'll have to go find out.
Perfect. Well, no, thank you guys for tuning in. As always, if you enjoyed the show, make sure you like it, share it, subscribe, share it to someone.
Yes.
Sharing a video on YouTube is great for the algorithm. It helps us out a bunch. We really appreciate it. Thank you guys, as always, for tuning in, and we'll chat to you next week.
Thanks so much, everyone. Take care.